notice that, I'm not wearing a tie today. I'm kind of casual. That's not true, actually. They read my last two editorials and they took my tie and my shoelaces away. They gave me these really nice little pills, though. We'll see how things go. Basically, until a couple of days ago, fear was stalking the markets again, but it, as has happened so many times in the last 5 years, traders have shaken it off. Happy days are here again. Everybody's cheered up. I do want to point out that there are a lot of issues that are coming to a head in the next little while. I would say right now, I have been vacillating on this, as my readers know, because I've gone both ways in the last couple of months. I think it's about 50-50 that one of two things happens. There's one of two paths forward, in my opinion. One is either a bear market, not necessarily really nasty bear market, although when these things start, the potential is always there for it to get ugly, especially with the amount of fast money that moves around the markets. The other potential, in my view, and right now I think it's literally probably a coin toss which way we go, is that the market convinces itself, as it seems to be doing in the last few days, that the Fed is never going to put interest rates up, ever, ever, ever. That in and of itself shouldn't give you massive increases in valuation, but it can potentially give you a weak bull market trend that can go on for 2 or 3 more years. Not a really crazy hot bull market, just basically a rising rather than a falling trend. But a side effect of that should be falling dollar, which would be better for commodities and particularly better for precious metals. And like I said, I'm 50-50. I'm on the fence about which way this is going to go. Basically, I can only point at one of these screens, but essentially we're right about here right now at about just a little bit above 2,000. As you can see, the break in trend's pretty obvious, but it must be said that this could be the equivalent of that in 2011, the Euro crisis correction, if you will. I mean, it was a nasty correction, but at the end of the day, it didn't last so long, and it really wasn't much of a hiccup when you look at the whole bull market. This could be the same thing again. Too early to tell. Here's a slightly closer view. As of about 20 minutes ago, we're actually about here. I still personally, I'm not going to be that comfortable until I see us getting up around this level. I don't think I would convincingly say that we've broken this downtrend and gone back up into an uptrend yet. I think we need a little bit more, and I'd personally like to see more volume for it to be a little more convincing. And I want to remind you that people think back on bear markets and they remember like the big horrendous crashes and the market dropping 10% a day. The way these things usually evolve, you generally have several months of internals weakening. That happens before you get anything terribly dramatic. So just because we haven't had some massive drop-off from this doesn't necessarily mean that we're back in an uptrend. These things do take time to develop. Basically, there's a couple of things here that I think, I wouldn't call them black swans. I mean, they're certainly not unknowns. There's a lot of traders that know this stuff is coming, but it's hard to say how much it's really priced in. My sense is it's not that heavily priced in yet, and these are the things that I think we have to be cognizant of in the next month or two. Here's the first one, and this is fairly important. One of the things that's driven the market is that profit margins have been very high, historically extremely high. And there's a lot of reasons for that, having to do with currency effects, having to do with the fact that U.S. companies apparently don't give people raises anymore. But if you take a look historically, and this is about a 32-year chart, there's 4 or 5 instances where you saw basically a 6% decrease in the margins, not in profits, but in the actual profit margin. There's only one case in the last 7 times that this has happened. That's the only case, 1985, where we didn't end up seeing a bear market and or recession following on that. Normally when you see that kind of a move in margins, it's not a good thing. Like I said, I'm not ruling out still having some kind of a weak bull trend, but this is something we've got to be cognizant of. The other thing, it sort of goes hand in hand with it, and that's forward earnings per share estimates. These are the ones that the analysts put together, consensus estimates. Interestingly enough, in the last couple of months, those have turned negative again. And as you can see, this is about a 20-year chart, a 30-year chart actually. This doesn't happen that often. I mean, the buy-side analysts don't give up very easily when it comes to basically saying guys are going to be losing money rather than making it, or profits are going to be falling. It's not that common an occurrence. And although this is barely negative, so it's not something I'd really be freaking out about, The trend here is pretty unmistakable. And again, normally in virtually every case where this has gotten significantly negative, a bear market's coming right behind it. So we can't ignore this stuff. And just one last one. This was something else I brought up in the last issue. This is something I keep an eye on. It's called GDP Now. The Atlanta Fed does this. And what this is, it's exactly the same calculation that the government uses in order to come up with their GDP calculations. And normally, in a given quarter, the first GDP calculation will be out a month later, and then there'll be a couple of revisions roughly a month after that. So although obviously GDP numbers are important, it's a very lagging indicator. It's not really that useful in a market sense. So both for the market, but also really for the Fed itself, the Atlanta Fed started doing this, where they basically just do that calculation on a running basis. And every time there's a new piece of important GDP affecting data, they recalculate it and they throw it up on their website. This is as of yesterday. You can see what's happened. The big drop here was not actually the payroll report. That drop was actually from the first estimate of the trade deficit, which was pretty horrendous. As it turned out, when it came in yesterday, it was slightly better than feared. That's why it popped back up. But right now, their current estimate of GDP now, this changes all the time, I remind you of that, is 1.1%. Wall Street's consensus estimate for third quarter GDP is 2.5%. You know, I just don't think a lot of this is priced in, and this is kind of what I'm, I wouldn't say it's keeping me awake at night, but this is stuff we have to be cognizant of. I'm not sure the streets really priced this stuff in yet. I don't think a bear market's guaranteed. A week ago, I would have said it's the most likely scenario. Now I would say it's probably 50-50 or maybe 55-45. I still think it's the most likely scenario, not necessarily immediate, but I think there's a good chance that we may have seen the highs of this cycle already in the S&P. It's just the valuations are so high right now, there isn't really a lot of room for valuation measures to get better, but there's lots of room for disappointment when it comes to the market. Now, one thing that could change this, and this is something that's really come forward since the last Fed meeting, but even more so maybe since the last payroll report. Basically, the Fed blew it. I mean, I did a lot of editorial on what I thought was coming before the last Fed meeting. I didn't think it really made sense, based on all this stuff I just showed you, for them to necessarily be raising rates, but nonetheless, I thought they should do it, because a 25% basis point rate increase isn't going to make that much difference to anything. And there was really a lot of danger that the credibility factor was really going to get damaged. They were already having problems, and I think after the last Fed meeting, the Fed has really, really blown their credibility now. The market does not believe what these guys say, period, paragraph. You could tell by the way the market reacted to a stand pat announcement at the last Fed meeting. It went up and then immediately dropped by a couple of percent. They sent every Fed governor out all over the place. They're running around the US right now saying, like, we're going to raise rates soon. We really, really mean it this time. We really, really mean it this time. Don't take your eyes off us. Bond traders are just basically rolling their eyes. You can see how the yield curve, meeting after meeting after meeting, has moved down. A couple of days ago, the Treasury did a big 3-month note auction, 0 interest rate. That's never happened before. They have never done a note auction where there was no interest rate, where it was bid so the yield was 0. And that's not, I don't think that's because these bond traders are freaking out and think the world's going to come to an end. I think it's because they basically just don't believe them anymore. They're just saying, like, you guys are full of crap. You're not going to raise rates. So sure, we'll go with 0 yield just to park our money there. That tells you how little credibility they have right now. Now, the interesting thing is, if you're sitting in the Fed right now, you realize you made a huge mistake not to raise it last time. These guys don't believe you. I think there's an outside chance, and I wouldn't call it more than an outside chance, that sometime between now and December they do a rate increase at one of the 2 meetings, simply to try to improve their credibility. If the bond market really absolutely doesn't believe they're going to raise rates and they do a rate increase, how do you think the market's going to react to that? Not well. Not well at all. Now, this scenario, if the Fed just stands pat for years, it does have some interesting side effects. This is basically a 1-year chart of that's actually not even 1 year, I think I just took a 4-month, of the US dollar index. You can see it's kind of been bouncing around. It was up around 100 earlier this year. That's where it topped out. it's kind of been going sideways, and it seems to be getting into this pattern where it's narrowing, and it's going to go one way or the other. And personally, I think the way it's going to go is probably down, and for two reasons. One, of course, is the Fed not raising rates. The other thing is, if you looked at all those charts I showed you in the first few slides, it looks fairly self-evident to me that U.S. growth is going to slow. It's probably going to do better than areas like, it is doing better in areas like Japan or Europe, but the differential in real GDP growth has been narrowing. If there's no rate differential, and there won't be if the Fed doesn't raise rates, and there's a smaller differential in the real growth rate, basically those are the two largest factors in determining currency pairs in terms of trading in and out of currencies. There's no reason to think that the US dollar isn't going to basically start falling off now based on those differentials changing and the US dollar not really having either a GDP advantage or an interest rate differential advantage. I wouldn't expect it to fall off a cliff. This is a massive market. You got to remember, this is like 10 trillion a day in trading on this market. But I could see it easily over the next year or so easing back 10 or 15%. That would be hugely helpful for commodities. It would also be hugely helpful for emerging markets. Part of what's driving the disasters in a lot of the emerging market stock markets is the fact that their currencies are getting clobbered because the US dollar has been so strong. And if you look at countries like Brazil as a prime example, their corporate sector, a lot of their debt is actually US dollar denominated. So when the reais is dropping 30 or 40%, it's a disaster for those guys. It's an absolute disaster. Their revenues in US dollar terms are dropping every day, but their debt obligations are not. So that letting the dollar fall off would actually probably, it's not going to get rid of these problems that we all know are festering, but it's going to let some of this stuff unwind. There's a lot of reasons to let it happen. Even though the Fed's not supposed to worry about anything offshore, there's pretty good reasons to do it. Basically, like I said, this helps all commodities, helps EM currencies. It may, in terms of commodities, the one I would expect it to help the most ultimately would be the precious metals and gold, simply because they trade most closely with it. The other one that's already helping, I think, is actually oil. I think part of the move that you're seeing in oil in the last week is the expectation that the US dollar is going to come off, because it's another thing that trades against it. You've seen some bottoming action in copper. These things all trade against the currency, and the currency movements are big in all of these markets. You can see here that the other thing where you may get a double whammy for gold at some point, this is the bounce that it had in late August. This is the correlation between the gold price and the S&P. Right here, it's down around minus 7.5, a fairly strong negative correlation. In other words, the S&P goes up, gold goes down, and vice versa. You're seeing that today. The gold came off a few bucks because the S&P had a bounce. If you get a combination of a weakening dollar and a weakening market, I think there's room for some moves here. Personally, I want to see gold get above, at a minimum, obviously, get above this high. I mean, it's nice to see these higher highs, higher lows, but I think we need another higher high at a minimum before people start taking this seriously. So we're not there yet, but I think there's a lot of reasons to think that we could get there in the next little while. So essentially, here's my two scenarios. I'd say 50-50, slightly more likely on the bear market. And again, I'm not saying a repeat of 2009. I'm saying a bear market, 20%, not necessarily the end of the world. That's mildly positive for gold if the Fed gets more dovish, which they would. The truth of the matter is that Wall Street does push the Fed around as much as they want to pretend otherwise. If you had a very steep crash where everything gets sold, I think you'd see selling in the gold market like you would anything else. I don't think it would be anywhere near as steep as you saw in 2007, 2008, because frankly, gold just isn't as widely owned as it used to be. A lot of the guys that were trading that out and during that market simply haven't got it anymore. The hedge fund guys are not really in the gold market that much. And I would expect it to basically be first out, as it was in 2009. If you looked at where things bottomed, the resource stocks actually bottomed in December 2008. The major markets bottomed 3.5 months later. The other scenario is, no raise for at least a year, a cornered Fed. I could see a weak uptrend. I don't know how much higher we'll get than earlier this year's highs. I wouldn't expect a rollicking market, but I could see a fairly shallow bull market that would go for 2 or 3 years. That's the good news. I think there'd be room to actually make a fair amount of money in a bunch of these stocks. One thing I would feel, I have to point out though, under that scenario, coming at the other end of that sort of 3-year extension to a bull market, I think the underlying debt situation would be far more severe than it is right now. And if we do have that sort of a situation when it rolls over that bear market, I think it would in fact be very ugly. So if we get door number 2, let's have some fun with it, but but you got to keep an eye on this and watch for it to roll over. And in the medium term, like through October, watch the August lows. I mean, I think if we have a pullback here, that's the big testing ground for me, around 1830ish for the S&P. I mean, if it falls through that, then I think we may confirm the short-term bear market scenario. But I think it's possible we do just get almost sort of a flatline market. It'll be good for commodities, but it will get dangerous the farther it goes on. So be nimble and don't be afraid to sell things.